Hi everyone, welcome back to Web Educates. Today we are diving into one of the most important aspects of financial accounting, which is balance sheet equation. Have you ever wondered how business keep track of their records or what they owe, what they own to outsiders, and what is left over for the owners? In this video, we are going to break down this simple accounting equation, which is fundamental to financial accounting. Let's get started. Accounting equation. Accounting equation. Accounting equation is also known as balance sheet equation. But before we dive into the formula or into the equation, let's get familiar with the terms on the accounting equation. There are what? Assets, liabilities, and equity. So we are going to take this term these terms one after the other before we go into the equation. So what is asset? What is asset? Assets is the resources owned or controlled by a business which is expected to bring future economic benefits into the business. That's where to bring future benefits into the business. Example of assets are, let's go into the balance sheets. You have assets which are inventory, receivables, cash, bank, land, building, equipment, etc. In the context of account equation, assets is the total value of what the company has at its disposal. In the context of accounting equation, or in the context of the equation, or accounting equation, assets is the total value. The total value of what the company has. Total value of what the company has, or what the company has at its disposal. So this is assets. Like I said, we are going to take it one after the other. The terms under accounting equation that we must be familiar with before we go into the equation proper. Assets is the resources owned or controlled by a business, which is expected to bring future economic benefits into the business. Example of assets in the balance sheet. You have inventory, receivables. The inventory, another name for inventory is stock. Receivables, which is debtors. Then cash, bank, land, building, equipment, etc. Then if we are talking about the equation itself, asset is the total value of what the company has at its disposal. The total value of what it has. Both the capital, both the liability, all added together. That is what the business has at its disposal. So that is an asset. Let's go to liability. Liabilities. 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 Liabilities are debt obligations that a business owes to outside party. Liabilities are debts obligations that the business owe to outside parties. Usually as a result of borrowing, usually as a result of borrowing of money or supply of goods and the services to the business. To the business. They require future settlement. Liabilities requires future settlement. Future settlement usually in form of cash. In form of cash. Example of liabilities. Examples, you have loans, you have accounts payables, you have taxes payables, you have taxes payables, payable salaries, etc. Then in the context of accounting equation, in the context of the equation, liabilities are, liability represents the portion of assets that is financed by creditor. Liability represents the portion of the assets that is funded by creditors. Liabilities are debt obligation that business owe to outside parties, usually as a result of borrowing of money or supply of goods and services to the business. Liabilities require future settlement, usually in the form of cash. Examples: example of liabilities: loans, account payables, taxes payables, payable salaries, and so on and so forth. They are talking in the context of the equation. Liabilities represent the portion of assets that is funded by creditors. This is liability. Let's go to equity. Equity represents the ownership interest in the business. Ownership interest in the what? In the business. Ownership interest in the business. Equity, it is the difference. Between assets and liabilities. Example of equity. You have ordinary share, share premium, share premium, retained earning, dividends, and so on and so forth. Then, in the context of the equation, assets represents what remain for the owners after debt are paid. The context of the equation. Equity shows how much of the assets are funded by the owners themselves. In the context of the equation we are talking about, equity shows how much of the assets. Equity shows how much of the value of the assets which are paid or which are funded, represent the value of the assets which were funded by the owners themselves. This is equity. Equity represents the ownership interest in the business. It is the difference between assets and liability. Then what are the examples of equity? Equity are ordinary shares, share premium, retained earnings, dividend, and so on and so forth. Then, in the context of the equation that we are talking about, equity shows how much of the value of the assets which were funded by the owners themselves, not the amount they borrowed, the portion of the asset that they funded by themselves. Then, summary of what we have just said so far. In summary, assets. This is what the business, what the company owns. Liabilities. What the company owes to outsider. What the company owes. Then equity. What remains for the owners after debt are paid. What remains for the owners? After debt are paid? After debt are are paid. The summary of the three texts: asset, liability, and equity. What's asset? Asset in summary is what the business owns themselves. Liability, what company owes to outside parties that supply goods to them or finance part of the assets. Equity, what remains for the owners after debt are paid. That is, when liability are paid, what is left over is equity. Now let's go into the equation proper. Let's now dive into the equation, which is assets equal liabilities plus equity. For example, if the total value of the asset is $1 million, that's the total value of what? Of the asset. And the assets are what? Are the liability plus equity. So, assuming our liability is $400,000 and the asset is $1 million, that means the balance is going to be equity, which is $600,000. For example, as I mentioned, let's say in the balance sheet, assets are, like I've mentioned, inventory, receivables. This is just for examples. See, in the balance sheet, there is a way of a classification of assets, liability, and equity. But let's just take this for example's sake. Receivables, cash, bank, land and building, equipment. Let me just, for example, EDC is what total value is $1 million. And what are the value of our assets? The value of assets is what? Is $400,000. And example of assets are what? We said, for example, loans, taxes, payable, salaries, salary payables, and so on and so forth. So the total is what? Is $400,000. That means the remainder is going to be what? Equity, which is, for example, ordinary share, share premium, retained earnings, dividend, etc. So the total value of this is going to be $600,000. So this must be equal to this plus 400 plus 600 give us what? $1 million. Don't forget to subscribe to the channel if you are a new subscriber, and if you are an existing subscriber to this channel, please Do continue to share our channels to others. Continue to share the videos to others. And God bless us to do so. See you in the next video.